There is a 9-month rule buried in the federal tax code that costs American families $75,000 every single time a parent dies, and most families never find out about it until it is already too late to stop it. The rule is not hidden on purpose. It is written into the Internal Revenue Code in plain English, but no one explains it to retirees, and no one explains it to their children. Before I walk through the 5 specific ways this rule quietly drains inherited wealth, I want to flag one detail that no estate planner will bring up in a free consultation, because it is the single most important step a family can take if they think the 9-month window has already started running. I will come back to it at the end of the video. Here is what makes this rule so dangerous.
It does not apply to one account. It does not apply to one form. It applies to almost every major asset your family will inherit, from the house to the retirement accounts to the stocks sitting in a brokerage account that your parent has not touched in 20 years. And the moment the 9-month window closes, the election that could have saved the family $75,000 or more disappears. The IRS does not send a reminder. The probate court does not flag it. The bank holding the accounts does not know to ask. Let me start with the deadline itself. The first thing that happens when a parent dies is that the estate has exactly 9 months to decide how every major asset gets valued for federal tax purposes. That decision is made on a document called IRS Form 706, officially titled the United States Estate and Generation Skipping Transfer Tax Return. Most families never file it because the current federal estate tax exemption is very high, and most estates owe 0 federal estate tax. The executor assumes there is nothing to file, but filing Form 706 is not only about paying estate tax, it is about locking in the valuation of every inherited asset at the date of death. That valuation determines the tax basis the children will use when they eventually sell the property. If the form is not filed or is filed late, the IRS has authority to challenge the basis the children later report, which can trigger capital gains tax on appreciation that should have been wiped out by the stepped-up basis rule. Here is how the trap works in practice. A parent buys a vacation home in 1985 for $50,000. Over 4 decades, the home appreciates to $500,000. The parent dies. Under the stepped-up basis rule in Internal Revenue Code Section 1014, the children inherit at a basis of $500,000. If they sell for $520,000, they owe capital gains tax only on the $20,000 gain above the new basis. But if Form 706 was never filed and no formal appraisal was commissioned at the time of death, the IRS can argue that the children have not properly established the stepped-up basis. The burden of proof falls on the children, not on the IRS. Without the filing and without a qualified appraisal dated to the date of death, the children may have to reconstruct the value using tax assessor records, multiple listing service comparables, or a retroactive appraisal, which the IRS is not required to accept. If the reconstruction is rejected, the children could owe capital gains tax on the entire $450,000 of appreciation. At a long-term capital gains rate of 20%, that is a federal tax difference of approximately $90,000 on a single house. Add a state capital gains rate of 5 to 9%, and the total can exceed $110,000, all because one form was not filed within 9 months of the date of death. The mitigation exists, but it has to happen in time. A qualified estate planning attorney can file a protective Form 706 even for estates well under the federal exemption, specifically to lock in the bases of inherited assets. Families can also commission a qualified retroactive appraisal dated to the date of death, which is more likely to survive IRS challenge when paired with a timely filing. But both steps have to happen within the 9-month window or within the 6-month extension Form 4768 allows if requested before the original deadline expires. Therefore, the single most important action an executor can take in the first 30 days after a parent's death is to consult an estate planning attorney about whether a protective Form 706 filing makes sense. For families holding appreciated real estate, stocks, or business interests, the cost of the filing is almost always less than the tax savings it locks in. The second way the 9-month rule costs families $75,000 has nothing to do with the form. It has to do with the clock that starts running the moment a parent dies. In 2019, Congress passed the Secure Act. Before the Secure Act, a child who inherited a traditional IRA from a parent could stretch the distributions over their own life expectancy, which might be 40 or 50 years. A younger beneficiary could take small annual distributions, keep the majority of the money growing tax-deferred, and spread the income tax burden across decades. That was the Stretch IRA, and it was one of the most powerful wealth transfer tools in the country. The Secure Act ended the stretch. Under the new rule, any non-spouse beneficiary who inherits a traditional IRA must empty the entire account within 10 years of the date of death. There is no exception for appreciated accounts. There is no exception for accounts that would push the beneficiary into a higher tax bracket 10 years, and the account must be at zero. Here is where the 9-month window intersects with the Secure Act. The regulations were updated in 2024 to clarify that if the original IRA owner had already begun required minimum distributions before death, the beneficiary must also take annual distributions during each of the 10 years, not just drain the account at year 10 every single year. The penalty for missing an annual distribution is 25% of the missed amount, reducible to 10% if corrected quickly. But the correction has to be filed within a specific window. The IRS does not advertise in any taxpayer notice. The 9-month rule also matters because if the executor does not notify the IRA custodian within 9 months and formally identify each beneficiary, the custodian may apply a default distribution schedule that accelerates the entire balance into a single taxable year. That acceleration can push a beneficiary from the 12% bracket into the 32 or 35% bracket for 1 year, creating a tax bill that wipes out a large portion of the inheritance. Consider this scenario. A parent dies with a $400,000 traditional IRA. They had been taking required minimum distributions for 3 years before death. They leave the IRA equally to 2 adult children, and neither child is told about the annual distribution requirement. By year 3, the IRS assesses a 25% penalty on the missed distributions for each child, which can exceed $15,000 per child before any income tax is paid. Then at year 10, both children realize they have barely touched the account. They have to drain the remaining balance in a single calendar year, which pushes both into the 35% federal bracket plus state tax. The combined tax and penalty bill across both children can exceed $120,000 on the original $400,000 inheritance. The family loses nearly a third of the account to taxes and penalties that would not have been assessed if distributions had started at lower bracket amounts in year 1. Therefore, the action for every executor and every beneficiary is to contact a certified public accountant or enrolled agent within the first 90 days after a parent's death to establish a proper distribution schedule for any inherited IRA. Do not wait for the custodian to send a reminder. The custodian will not send one. The third way the 9-month rule costs families $75,000 is a trap that most parents step into years before they die, thinking they are doing something smart for their family. The trap is called carryover basis, and it applies whenever a parent gives an asset to a child during the parent's lifetime instead of letting the child inherit it at death. Here is the difference. When a child inherits an asset at death, the cost basis resets to the fair market value on the date of death, and all the appreciation during the parent's lifetime becomes tax-free. If a parent bought stock for $10,000 in 1990 and it is worth $200,000 at death, the child inherits at a basis of $200,000. If the child sells the next day for $200,000, the capital gains tax owed is 0. But if the parent gifted those same shares during life, the child takes carryover basis. The child inherits the parent's original cost basis of $10,000. If the child sells for $200,000, the child owes capital gains tax on $190,000 of appreciation. At a 20% federal long-term rate plus a state rate of 5%, that is approximately $4,750 of tax. The same asset transferred at a different time costs the family almost $50,000 in unnecessary tax. The 9-month window matters because it is the limited period during which a family can sometimes undo a tax outcome to the parent locked in. The Internal Revenue Code allows a qualified disclaimer of an inheritance, but the disclaimer has to be filed in writing within 9 months of the date of death and has to meet the requirements of Code Section 2518. A properly filed disclaimer can redirect an inherited asset to a contingent beneficiary who would receive it with a better tax outcome. After 9 months, the election is lost. The most common version of this trap is the parent who adds an adult child to the deed of the family home, thinking it is a simple way to avoid probate. What actually happens is that the parent gifts 1/2 of the home to the child at the parent's current basis, triggering gift tax reporting on Form 709 and locking the child into carryover basis on that half permanently. When the parent dies, the remaining half receives a stepped-up basis, but the transferred half does not. The child ends up with a home that has 2 different cost bases, and when they sell, they owe capital gains tax on all the appreciation that occurred on the transferred half during the parent's lifetime. On a home a parent bought for $60,000 in 1980 and worth $600,000 at death, adding the child to the deed in midlife can cost the family over $60,000 in additional capital gains tax when the home is eventually sold. There are alternative tools in some states that accomplish what the parent intended without the tax damage. A transfer on death deed or a ladybird deed in states that recognize one can name a child to receive the home at death without any lifetime transfer, preserving the full stepped-up basis. But the rules about which states recognize each tool change over time, so the form has to be verified with the local estate planning attorney. Therefore, the action is to review every piece of real estate and every joint account before the 9-month window ever opens. If a parent has added children to titles during their lifetime, an attorney may be able to restructure the arrangement before death in a way that preserves the stepped-up basis. After death, the options narrow dramatically. The fourth way, the 9-month rule costs families $75,000, is an election that almost no executor knows exists. Under Internal Revenue Code Section 2032, the executor of an estate has the option to value the entire taxable estate as of 6 months after the date of death instead of the date of death itself. This is called the alternate valuation date election. The election exists specifically to protect families when the estate's assets decline in value during the months immediately following a parent's death. Here is why it matters. Suppose a parent dies during a stock market peak in January. The estate includes $500,000 of index fund shares and a home valued at $600,000. 6 months later, the market has corrected 20% and the index fund shares are now worth $400,000. If the executor uses the date of death valuation, the stock portion of the estate is valued at $500,000. If the executor elects the alternate valuation date, the stock portion drops to $400,000 and the total taxable estate is $100,000 lower. For estates near or above the federal estate tax exemption, this election can save hundreds of thousands of dollars in estate tax liability. For estates below the exemption, the election can still matter because it also resets the stepped-up basis that the heirs will use. And that last point is where the trap appears. Because the election lowers the basis, heirs who sell the assets after inheriting them later pay more capital gains tax on any appreciation between the alternate valuation date and the eventual sale date. So, the election is only the right move when the estate tax savings outweigh the basis reduction. The 9-month window applies because the alternate valuation date election must be made on Form 706 within the 9-month filing deadline. Once 9 months pass without the election being affirmatively made, the date of death valuation becomes permanent for the entire estate. There is no retroactive election. There is no extension of the election specifically beyond the General Form 706 filing extension. If the executor is not aware of the option and does not consult a qualified tax professional within the first 6 months, the election is lost forever. Consider this scenario. A parent dies in December at the peak of a market rally with an estate valued at $2 million on the date of death. Most of that value is in appreciated index funds. By June, the market has dropped 15%, and the same funds are worth $1,100,000. The executor, with no professional guidance, files nothing, and the election passes unclaimed. Whether the election is the right move depends on each family's asset mix, the estate tax exposure, and the heir's future sale plans. In some cases, letting the higher basis stand protects heirs from a larger capital gain later. In others, the election saves more than it costs. The point is that the decision requires actual modeling, and letting the 9-month window close without that conversation is how families lose the option entirely. Consider how the decision actually plays out when a family has the right conversation in time. A certified public accountant models both options in month 4 after a parent dies. The date of death valuation keeps the estate at $2 million and locks in a high stepped-up basis, which protects the heirs from capital gains tax on future sale. The alternate valuation date, if elected, drops the estate to $1,100,000, which reduces estate tax exposure, but also reduces the basis the heirs will use when they eventually sell. For this family, the heirs plan to sell most of the inherited assets within the following year. The accountant calculates that the higher date of death basis saves the heirs over $40,000 in future capital gains tax, compared to roughly $12,000 in estate tax savings from the lower alternate valuation. They choose the date of death valuation. The only reason the choice was available at all is because the conversation happened inside the 9-month window. Therefore, the action is to have a certified public accountant or estate planning attorney model both valuation options as part of the Form 706 evaluation. The decision has to be made before the 9-month deadline expires, and it requires specific calculations that only a qualified professional can perform accurately against each family's asset mix. The fifth way the 9-month rule costs families $75,000 is the quietest of all, because it begins with a form that was filled out correctly decades ago and never updated. Every retirement account, every life insurance policy, every transfer on death brokerage account, and every payable on death bank account has a beneficiary designation form. When the account owner dies, the beneficiary named on that form inherits the asset directly outside the probate process. The asset does not pass through the will, it does not pass through the court, it goes straight to the named beneficiary, usually within a few weeks of the death certificate being filed. But when the beneficiary designation is outdated, missing, or invalid, the asset falls into the probate estate. Once inside probate, the family faces three costs: attorney fees, typically ranging from 3 to 7% of the estate value depending on the state; court filing costs of a few hundred to several $1,000s, and the delay itself, which can extend from 6 months in simple estates to several years in contested ones. On a $300,000 retirement account that falls into probate because the designation was blank or named a deceased person, the probate fees alone can range from $9,000 to $21,000. The delay can force heirs to cover holding costs and property taxes out of pocket while the estate is tied up and the account continues to be subject to estate income tax during the probate period, which often exceeds the rate a direct beneficiary would have paid. The 9-month window matters in two specific ways here. First, if the executor wants to disclaim an inheritance on behalf of a deceased primary beneficiary, so the asset passes to the contingent beneficiary, that disclaimer must be filed within 9 months of the date of death in writing, meeting Code Section 2518 requirements. A properly structured qualified disclaimer can sometimes rescue a family from the probate path when a primary beneficiary predeceased the account owner and the form was never updated. After 9 months, the asset is locked into the estate. Second, outdated beneficiary designations frequently still name an ex-spouse from a prior marriage. In several states, divorce automatically revokes the designation, but federal law supersedes state law for retirement accounts governed by ERISA, which includes most corporate 401k plans. An ex-spouse still listed on an ERISA plan may inherit the account even where the divorce decree explicitly said they cannot. The only way to prevent this outcome is to update the designation during the account owner's lifetime. Consider a concrete version of this trap. A 72-year-old man remarries at age 55, years after a divorce ends his first marriage. His corporate 401k from his earlier career still names the first wife as beneficiary because the form was filled out decades earlier and was never reviewed after the divorce. The divorce decree specifically says the first wife waives all claims to retirement assets. But the plan is governed by ERISA, and federal law preempts state divorce decree language on beneficiary designations for covered retirement plans. When the man dies, the account worth $380,000 pays out to the first wife within weeks of the death certificate being filed. His second wife, who shared a home with him for 17 years, receives nothing from that account. No federal remedy is available to the second wife. Everything the divorce decree promised is overridden by a single form that was never updated during his lifetime. The mitigation is entirely pre-death. Every adult over age 60 should review every beneficiary designation every 3 years. A financial advisor or estate planning attorney can run a simple audit of retirement accounts, life insurance policies, transfer on death deeds, and bank accounts in less than an afternoon. The cost of the audit is almost always less than $1,000, while a single contested probate case can exceed 10 times that amount. Therefore, the action for every family is to audit beneficiary designations now before the 9-month window ever starts running. Once the window opens, the options collapse. Here is what needs to happen in every family while there is still time. First, for anyone who is the executor or likely executor of a parent's estate, make a list of every major asset the parent owns: real estate, retirement accounts, brokerage accounts, life insurance, business interests. Next to each asset, note whether a current beneficiary designation is in place and when it was last updated. If any asset lacks a current designation or names a person who has died, call an estate planning attorney this week. Second, if a parent has already died and the 9-month window is running, do not wait for the probate court or the IRS to tell the family what to do. Contact a certified public accountant and an estate planning attorney within the first 90 days after death to evaluate whether a protective Form 706 filing is advisable, whether the alternate valuation date election is worth modeling, and whether any inherited IRA requires an immediate distribution schedule. The professional fees for these evaluations are almost always recovered several times over in tax savings. Third, for any parent who added a child to a deed during their lifetime or gifted appreciated assets to children in prior years, review the transfers with an estate attorney immediately. Some can be restructured before death in a way that preserves stepped-up basis. Others cannot. The only way to know is a professional review. Fourth, do not assume a general financial advisor has accounted for any of this. The intersection of of Form 706, the Secure Act 10-year rule, carryover basis, the alternate valuation date election, and ERISA beneficiary rules is a specialized area of estate tax law. Many advisors are excellent at investments but have limited estate tax expertise. A second opinion from a certified public accountant or enrolled agent who focuses on estate and trust taxation is not a luxury. For any family with significant assets, it is a requirement. The 9 months start the day a parent dies. The IRS does not send a reminder, the court does not flag the missed elections, and every decision that does not get made inside that window becomes irreversible the moment it closes.